Hello everyone, my name is Roman Ziruk. I am a part of a market research team at eBury. I've been with eBury for 6 years. I'm a senior analyst. I'm based in Warsaw and I'm focused on Central and Eastern European currencies. I focus primarily on the Polish zloty, also on Czech koruna, Hungarian forint, Romanian leu. I also cover Swiss franc and the Chinese yuan, and additionally, sometimes other emerging market currencies. And today I'll be presenting to you a short update on the situation in the FX markets and in general, the macroeconomic developments that are affecting the currencies. So let's start. The key talking points right now in the markets primarily are hanging around inflation. Inflation data is continuing to increase, to show increases in many economies globally. Inflation is widespread. This is not only Europe, not only Central and Eastern Europe, not only Europe, but also large economies in most countries. And in fact, if we look broader right now, inflation is also increasing in a region where it wasn't present, at least for a significant while, which is Asia. This inflation has many causes. One of the big ones is the pandemic, but right now the markets are focusing on the effects of soaring energy prices and the effect, which is an effect in large part of a Russian invasion of Ukraine. Nonetheless, there are also additional reasons for that. We are seeing that the weather changes in this year have been particularly severe in many regions. We are also seeing a continued supply disruptions, although to a lesser degree than what we have witnessed in previous quarters. So this is an optimistic news. Nonetheless, in general, the energy prices are continuing to soar and are leading to a something that the British are calling right now a cost of living crisis. And I think this term should be applied not only to the UK, but also more broadly, including Czechia. Also, another theme which is linked to elevated inflation is recession. Markets are worried that the elevated inflation and the monetary policy tightening that has started to become more and more aggressive threatens the economies and will push them in recessions. Macroeconomic data as for the past few months has been holding rather well. However, we are right now starting to see cracks in the data, and it's quite clear that the slowdown is underway. Central banks, as I mentioned, are raising rates aggressively to fight the consequences of inflation, because inflation is also leading to a variety of other issues, such as external imbalances. This is particularly clear in Central and Eastern Europe. Also, this is leading to elevated inflation expectations. And if they were left unchecked, then the inflation problem might not be only a problem for a short while or a medium term, but for a longer term. And the central banks are trying to prevent that. One of the most important stories over the past few months, but also this week, is a significant drop in the euro dollar. At the beginning of the week, euro dollar dropped below 0.99, and it was the lowest level in 2 decades. This is primarily linked to the European energy crisis. The drop on Monday can be linked to the announcement by Nord Stream on Friday that they will not supply gas by Gazprom, that they will not supply gas through Nord Stream pipeline. And it was confirmed that a full restoration of gas supplies will not take place. Kremlin stated that it will not take place until the sanctions are lifted. Global inflation is continuing to exceed expectations. On the right-hand side, you can see the inflation surprise index for main economies. And this index has reached the highest levels in decades soon, a few months ago. However, it has since declined somewhat. Nonetheless, as we can see, this is still far above the historical average, and still inflation surprises are prevalent in many economies. We are seeing it with most of the data releases, not only in main economies, but also in emerging markets, and particularly in the region that I cover. The inflation is different across the board. So in the US, it has slightly different composition than in Eurozone, let's say. In Eurozone, it's more of an issue of energy prices. Nonetheless, the fight against inflation has taken a very similar form, and the central banks are raising interest rates and tightening monetary policy in other ways to not allow the elevated inflation expectations to anchor, and not allow the disturbances to the external situation, to the macroeconomic landscape, to just be uncontained. The main factors, as I said, are many, and they start with the pandemic. Pandemic did not allow people to properly use their assets to spend, to travel, to conduct normal private economic lives. So there is some degree of demand that people have been, that hasn't been unleashed, and that is unleashing right now, or has been, depending on the country, earlier this year. We also are seeing supply chain disruptions. This is clear this was clear for practically 2 years right now, and they still remain, and they are worsened by the situation in Asia, with China continuously continuing to stick to zero COVID policy and introducing lockdowns. And this leads to a issue for the Chinese manufacturing sector. And Chinese manufacturing sector is also important for countries in faraway places such as our region. Thus, we all are right now suffering consequences of the situation there. However, as I mentioned earlier, the degree of supply chain disruptions right now has lessened from what it was a few months ago, a year ago, or when the pandemic started. So this is an optimistic news in this context. Nonetheless, China lockdowns present a risk in that aspects, and also coronavirus, even though right now in most countries we are seeing that there are very little restrictions to almost none. It still could present some risk to the supply chains. However, economies have started to adapt to it. So even if, let's say, we would see another wave, the degree of disruptions linked to that would probably not be as severe. The biggest issue that we are dealing right now is increase in commodity prices. We have seen prices of oil rise quite significantly, above $100 per barrel earlier this year. But right now, what we are particularly focusing on is increase in prices of other energy commodities, such as coal and gas. Those are important. Depending on the country, they obviously have different energy mixes. Nonetheless, an increase in prices of those two commodities is negatively influencing the economic situation, both in Europe as well as in such a faraway places such as Australia. So this is although the problem is concentrating here, other countries are also dealing with it, even though perhaps to a slightly smaller extent in most cases. This is a consequence of war, in large part, of Putin's attack on Ukraine. Also, this is a consequence of weather disruptions. We have seen particularly hot weather during this summer in Europe, but not only in Europe. We have also seen droughts in China, in many other places. which have also boosted the demand for energy and also caused the disturbance to energy productions. So this is quite a complicated issue, not only related to war, but also that has links to demand and the weather situation. But inflation is significantly overshooting central bank targets in all of the G10. So every main economy is seeing inflation above what they would prefer to see. And this is a particularly significant issue in the economies which we are calling G3. So the US, Eurozone, and the United Kingdom. Originally, the G3 is Japanese yen. However, because of our British origin, instead of yen, we include the UK to the G3. The biggest overshoot is in the UK. Exactly, it's 8.1 percentage points above the target. In the US, it's slightly smaller, but still significant. Looking historically, right now it's 6.5 percentage points. In Euro area, it's 7.1 percentage points. This situation has led to an aggressive action from most central banks in main economies. 9 out of 10 G10 central banks have raised interest rates, and most of the central banks in this group have raised rates very aggressively by 150 basis points or more. The only central bank that did not raise rates in the G10 is the Central Bank of Japan, Bank of Japan, and they are still sticking to a very easy policy. And this has a consequence in that they are seeing a significant depreciation of the Japanese yen. And although what we are seeing right now is an elevated risk in the markets and currencies that are traditionally seen as safe havens, such as the US dollar and the Swiss franc, are benefiting from that, the yen is not benefiting because the central bank is keeping its policy ultra loose. Other central banks are raising rates, which means that the divergence in policy is increasing, and this is leading to a pressure on the currency, and this pressure is quite significant. As I mentioned, in the past few months, the situation in the economy has been relatively stable. However, right now we are starting to see some cracks. Looking at the United States, the US has been in the technical recession, has entered it in the second quarter. The GDP contracted by 0.6% annualized after 1.6% in the previous quarter. Nonetheless, this is not viewed as an actual recession, let's say. The situation in the US with the labor market and generally doesn't seem to be particularly bad. Nonetheless, what we have started to see in just recently has been a rather significant decline in the PMI data. Services PMI data has declined to 43.7 in August. And whenever the PMI declines below level 50, and this is a negative sign, this is a sign that the sector is contracting. And because there is a high correlation between the PMI data and the actual GDP data, this is a sign that the US economy right now is cooling. The data for the services sector actually at what we are looking at, the 43.7 is quite bad. We still don't have full confidence that the actual situation is as bad as the data is showing it. We still have to wait for other readings, hard readings, because what I'm presenting right now is a reading based on the survey. So it's not, let's say, entirely descriptive of the economic situation. Nonetheless, this is an indicator that is the most current and that has historically been highly correlated with the GDP. So what we are seeing is a slowdown. The IMF is expecting that the growth in 2022 will slow to 2.3%. In 23, it's set to slow to 1%. When it comes to Euro area, we are seeing similar data, and the composite PMI, which combines the manufacturing and services, has declined below 50. It's in contraction territory, 48.9 in August. It was actually revised down. So the data is worse than initially thought. The growth in the Eurozone is set to slow to 2.6% in 2022 and 1.2 in 23, according to the IMF. Nonetheless, because of the energy situation, the risk to growth seems to be to the downside. With the UK, we saw a contraction of GDP in the second quarter, 0.1%. We saw a relatively poor readings with regards to spending. Retail sales were down 1.9% in the first half. And what we are seeing right now is also a decline in composite PMI indicator below the level of expansion. So 49.6 in August. This was also, as was the case with the Eurozone, revised down. So not particularly good news, sustain a prolonged period of negative growth. However, this will largely also depend on the energy situation and on the UK's response to the energy crisis and cost of living crisis. In 2023, the recession, according to the Bank of England, is set to be at 2.1%. So this is quite significant and one of the biggest downturns expected among major economies. However, this slowdown or recession that we are likely to see is not like other downturns in the past, or at least there is a significant degree of hope that this is the case, because what we are seeing right now are extremely tight labor markets. We are seeing that the unemployment rates are at near multi-decade lows, and this is the case in most economies we cover. This is the case in Eurozone. This is the case also in the UK, as you can see on the right-hand side. But also this is the case in the Central and Eastern Europe, where the market tightness is visible in both the very low unemployment rates, but also a high wage increases, in nominal terms at least. We are seeing one other thing that makes the current situation different from the past is the pandemic. The pandemic allowed households to increase their savings rate, and so there is some degree of savings, or there should be in most economies, which should provide a smoother transition and help to alleviate the shock that we are currently entering. Looking at the indicators of financial stress, there hasn't been too many to indicate that the situation is in any way problematic for the financial sector. So there is a rather small risk that we are going to see a repetition of the 2008 crisis. Looking at the stock, the equity markets, the DAX is obviously down. However, it's still trading around the levels we've seen 2 years ago. Shares of European banks, so an indicator also of the stability of the sector, are largely steady. The 5 banks have largely held their value since March. And the spread between the euro-denominated high-yield corporate bonds and the US Treasuries remains contained. So the financial markets does not send us signals that the situation there is a cause for concern. Nonetheless, the situation in the real economy will deteriorate. So this, what I mentioned, the situation in the labor market, the degree of savings rate, and the no issues in the financial sector, no significant issues, support our call that the recession should be, in most cases, short and rather shallow. Nonetheless, the worries that the situation has caused had an effect on the FX market. They resulted in the sell-off in risky currencies and an appreciation of those that are perceived as safe, but also the appreciation of those where the central banks were the quickest to act and the most aggressive to act, meaning they raised the rates the most, and the rate differentials between those countries and the outside world increased the most. And this has been the case in the US. Federal Reserve have been very aggressive, hiking rates by in total 225 basis points since March. And investors expect that they will, in the short term at least, be similarly aggressive. And investors are torn between expecting a 75 or 50 basis point increase at their meeting later this month. Nonetheless, the markets right now are leaning towards a more aggressive of the two scenario, so a 75 basis point increase. As I mentioned, the recession fears are supporting the currencies that are deemed as safe. So primarily the US dollar and the Swiss franc. Both countries have raised rates. Switzerland recently, in June, raised rates by 50 basis points, which was completely unexpected. And they are on course to raise rates also this month, perhaps by 50 or 75 basis points, which should make the Swiss franc still a relatively attractive currency for investors in the short term. The dollar, comparing to the beginning of the year, right now is 14% more expensive in general. The US dollar index, which tracks the dollar against main peers, is 40% above the levels in January, which is a very significant increase. The FOMC, the US Central Bank, is going to stay on course, at least in the short term, and they are going to hike rates aggressively. The inflation in the US is easing, looking at the data. However, it still remains very high. The levels of 8.5% in July, with core CPI, which is the inflation excluding food and energy prices, the ones that are most volatile, at 5.9%. Those are levels significantly above the central bank targets, and they require policy action. However, in the medium and the longer term, the central bank may start turning more towards the economic situation with regards to activity and growth, because what we are seeing is a slowdown, and the data is not particularly optimistic, especially the data that we have received quite recently, namely the PMI numbers, although it is yet to be seen whether they accurately represent the situation. We are thinking that a 50 basis points move in September is a safer bet for the Federal Reserve. Nonetheless, a 75 basis point would not be a shock to anyone and would be in line with rhetorics of some members of the policy committee. With regard to the Eurozone, the primary issue right now is an increase in energy prices. They have come down quite a bit since their heights reached in August. Nonetheless, the situation is still very difficult, as the prices are few times as high as they were just a year ago. Looking at comparing the current prices to what we've seen at the beginning of the year, the benchmarks for natural gas are approximately 300% up, which is a significant increase, something really unprecedented. This is, of course, linked to the Russian war in Ukraine and the Russian blackmail. Obviously, Russia is a commodity exporter, so the primary way which allows the country to finance war is through commodity exports. Russia knows that European countries depend in a large part on Russian supply of gas. So they want to pressure those countries to ease the restrictions or maybe stop supporting Ukraine with cutting off gas. Russia has done so in the past months. We have seen on a number of occasions gas being either decreased or completely cut off. And recently on Friday, after a 3-day period of a maintenance, Gazprom announced that they are not going to switch gas back on in Nord Stream 1. And on Monday, Kremlin stated that they will not return the full flow of gas to Europe until the sanctions are lifted. This is proving particularly problematic for the Central European countries. The biggest issue this should pose for Germany, also countries like Italy and the countries of our region. So this is certainly something that is already affecting the economy. In Poland, for instance, we have seen a number of companies laying off a part of their workforce. The companies that are energy intensive or that require a lot of gas had to make hard choices. However, the situation should be eased by imports from other countries of a liquefied gas, and also some declines in demand for gas, and also some support from the states. This is a developing situation, and we are practically every day seeing announcements from economies in the Eurozone on how they are planning to support the economy. We have seen announcements of liquidity lines to energy companies. There may be some idea to support the collateral so that the function can be maintained, or there may be some, actually they have already been introduced some measures in some countries to support consumers, so that not all of the increase is passed on to consumers. This is down to the regulatory bodies, and they typically choose not to pass on the entire cost, at least not at once, but also for the struggling consumers. Many countries, including, let's say, Poland, have developed tools to reimburse consumers or to ease the pain of the energy crisis. And as I mentioned, we are seeing the gas prices increases. However, this also is translating to other commodities. Coal prices are also on the rise. And this is not only a European issue, because what we are witnessing right now could be kind of a bidding war for gas between countries. So the pressure on gas prices could be maintained because of that. Obviously, this is something negative for manufacturing, particularly for energy intensive companies. We think that we are starting to see negative consequences already, and this is something that is enhancing increasing the pressure on households, because it is driving up the prices and extending the cost of living crisis. The situation in the euro-dollar, as I mentioned, is quite dire at the moment. We have seen significant decline through the year, and the euro has fallen to the lowest level since 2002. Right now it is back below parity with the dollar, around 0.99. And although we believe that in the medium and longer term, the euro should rebound, particularly after the economic prospects improve and after the European Central Bank delivers aggressive interest rate hikes, nonetheless, the current situation is that where the euro dollar is below parity. Looking at the UK, the inflation is overshooting the most in the main economies. In July, inflation increased more than expected to 10.1%, and this is a fresh 4-decade high. There are different expectations regarding how high this can go. The MPC is seeing inflation of 13%, Citi is seeing inflation of 18% or more in early 2023, but this will largely depend on the developments in the energy sector and also on the response of the government, because the government can easily lead to a decline in inflation, or at least to lower the pace of increase. But this remains to be seen how it will be, how they will proceed with it. The market right now is betting that the Bank of England will react to this inflation uptick by hiking rates aggressively. They're betting that the Bank of England will hike by 75 basis points in September and November, and follow with a 50 basis point hike in December. The sterling is driven more by recession concerns than the Bank of England policy. And investors, obviously it's the highest in G10, the highest overshoot, and are seeing the inflation as sterling negative. UK also has certain issues with regards to the external imbalance, and this has been particularly pronounced in 2022 so far, according to the data, which also can be a drag on the currency. This has often proved to be the case in emerging markets, but when it is the size that it is in the UK, this can also be an issue. So sterling has been an underperformer in recent months, and this is in large part because of the cost of living crisis. Looking at the emerging market currencies, we clearly see the winners and losers, and this is related primarily to whether they import energy commodities or export them. The main exporters include the Brazil and Latin American countries in general. So we can see on the right-hand side that they're on top of the chart of performance against the US dollar since the beginning of the year. And the currency that has been performed the weakest are on the bottom. So Hungarian forint, Polish zloty, Czech koruna are one of the worst performers. Obviously Turkish lira, where inflation is 80%. So this situation the discrepancies in the developments in the FX market can be tracked to the position of a country with regards to trade, and particularly with regards to trade of energy commodities. We are starting to see slowing activity in Central and Eastern Europe. This has been particularly clear in Poland, where the economy contracted in the second quarter and where the manufacturing PMI has dropped like a stone in the past few months. For the past 4 months, we have been far below the level of expansion. So, but this is also starting to be the case in other countries. Poland is not the only one which is experiencing issues. Czech koruna in all that is remaining relatively strong. Czech koruna is favored by investors typically when it comes to the Central and Eastern Europe, when there is a risk event, as the country is the highest rated, is perceived to be the safest, the most developed, and the external imbalances in Czechia are the lowest. The current account deficit of 2% is considered small, particularly compared to Czechia's peers. If we look at, let's say, Romania, we are seeing levels of 7%, 8%, which is quite extreme. Also, one thing that makes Czechia different from its regional peers is the high level of FX reserves. Czechia has basically a very similar level of reserves as Poland, approximately 150 billion euros. And this covers approximately 10 months of imports, depending on the month. And this is a healthy level by any means. The lowest level that the country should hold is perceived to be approximately 3 months of imports. I would say perhaps 6 is a better number here, depending on the country, of course. But at 10 months of imports, the pressure on the currency should be, or the central bank is able to alleviate the pressure on the currency. And the Czech National Bank has been doing that. Actually, the activity of the Czech National Bank in the market has increased right around the time of appointment of Ales Michel to the governor of the Czech National Bank. And this has allowed the Czech koruna to remain the best performing regional currency, save the Romanian leu, which is driven by seasonal factors right now and has appreciated quite a bit. And this has allowed the currency to perform largely in line with our expectations. So we are seeing a limited external pressure, sizable reserves, and those factors should enable the central bank to support the koruna in the coming months if the central bank deems it appropriate. They stopped hiking rates, but they are keeping the pledge to support the currency if there is a need to do so. And supporting the currency can work in a pretty much the same way as hiking interest rates, or a very similar way. It is can be seen as a way of tightening monetary policy. Czechia's economy is performing better than expected. In the second quarter, we had a similar sized expansion as in the first one, which was quite surprising because most economies predicted a decline. The decline happened in Poland. It was much more significant than expected, but luckily Czechia avoided that. Labor market in Czechia is very tight. The unemployment rate in July fell to 2.3% and is the lowest in the European Union. Nonetheless, the country has its problems, which are obvious if we look at the inflation data. In July, inflation reached 17.5%, and it is expected to edge higher in the coming months, with the central bank assuming it to increase to approximately 20%. Real incomes in Czechia have dropped significantly. You can see on the right-hand side, this has been a decrease of close to 10%, the highest on record, which is one of the biggest reasons why there is a expectation of economic slowdown, because the consumer's purchasing power just isn't as it used to be. So the Czechia's economy is expected to post negative growth in late 2022 and early 2023. The Czech National Bank is assuming that the growth will be 1.1% over the year. Private forecasters are generally more optimistic. Nonetheless, with the energy crisis in Europe, the downside risks to growth are quite significant, and also the decline in real income growth, in real incomes, have been worse than expected, at least by the consensus. So this is something that should also pressure the economy going forward, as in the next quarter, 2 quarters, perhaps even 3, we are unlikely to see a significant improvement in that regard. With regards to the FX market in the rest of 2022, the key themes are likely going to remain the same. So recession fears, driven in Europe by the energy situation and ensuing cost of living crisis. Also, many central banks are nearing an end to the hiking cycle. Czechia likely reached the ending point. Poland is very close to reaching it, and certain main economies may be on the same course, although the Federal Reserve is not indicating that this is the case for them, at least in the near future. With regards to the rate cuts, we think that in most cases those remain a way off. In Czechia, Czechia might be an exception, with rate cuts coming in 2023, but this largely depends on the energy situation, on how pronounced the recession is, and whether the central bank can allow to cut rates. And also, a thing I mentioned at the beginning, China growth concerns, they have become particularly pronounced over recent weeks because of the deteriorating COVID situation there and lockdowns. Recently, we had a lockdown of a 6th largest city, Chengdu, and this could also put a pressure on other economies, could lead to certain disruptions in trade. So I think that this is a theme that is also worth observing. And this would be all on my part. I think I ran slightly over time. If there are any questions, I'm very happy to answer them. So you can post them, or they will be shared with me. Thank you very much.